street without all the insane fees and lockups and barriers of entries that you see with a lot of other traditional hedge funds. Ambassador, I think we actually just heard some life from you, so let me know if you're also able to speak here.
Yeah, I think I'm in now. I don't know what happened. Can people hear me now?
Yep. Yep, we can hear you loud and clear.
Great. I mean, the last person anybody really wants to hear from, but still, it's good to be actually here and alive. So I'm going to go ahead and mute myself again. And let you finish your thought.
No, that's beautiful. So I guess we'll just get kicked off while we're trying to get Zed on stage as well. Ambassador, if you wouldn't mind resending an invite to Zed Francis, he should be in this ROD group here. But really what we're trying to focus on is, as I alluded to, hedge fund-like strategies in the ETF wrapper. Honestly, as a 20-year veteran in the ETF space, it's frustrated me to no end that there haven't been more hedge fund-like quality products in the ETF wrapper. And candidly, that's in many cases because hedge funds either don't want to show their quote unquote secret sauce, or most importantly, I think they don't want to have to lower their very large fees. A traditional hedge fund will charge 2 and 20, and you just can't charge a performance fee in an ETF wrapper. And an average 2 and 20 fund might charge upwards of 4% overall. And I think if any of you all saw an ETF that came out with a 4% management fee, I think you'd probably run and hide, rightfully so. It doesn't mean that there's not real alpha in hedge fund strategies. Oftentimes, hedge funds get a bad name for their performance, but their outperformance oftentimes gets eroded by these very, very large fees. And so in an ETF wrapper, not only can you offer these strategies in a much more cost-effective manner with a much more realistic fee in place, you can also do so taking full advantage of the tax benefits of an ETF wrapper. I know many of you all might understand the tax benefits in an equity ETF, but that same tax advantage is also available using options. So we're very pleased to kick off our first 2 derivative income options ETFs just about 3 weeks ago with our income stack lineup. I think our 2 main slogans on this income stack lineup are risk management over strike sellers and distribute responsibly. And what I mean by that is, obviously there's a plethora of derivative income strategies. Oftentimes we see our competitors out there will once a week, once a month, once a quarter, sell a call on an underlying basket and kind of just wait and hope that they don't get called away. And some of those have performed pretty well. But what I mean by focusing on risk management over just being a strike seller is you don't always get a consistent portfolio on a day-to-day basis as an investor in those products. That's because every day the market moves, your actual exposure to the underlying market based on where their portfolio is versus their calls can drastically vary over time. One day you might have exposure that's equal to 2/3 of the S&P. Another day you might have exposure that's half of the S&P, and the third day you might have exposure that's 20% of the S&P. And that's actually by design in these strategies. A lot of the back-tested strategies you've seen in indexes in the space do just that. But, I think a lot of people have seen, especially with the more conservative strategies in that space, they're experiencing maybe better risk-adjusted returns, but not better total returns, right? And so in our process here, being risk managers, what does that actually mean? That means we have up to 10 rebalancing periods a week. We won't just sell a call and just wait and see what happens, especially in so much volatility like you've seen in the last couple of weeks. It's very important, in our opinion, to always rebalance your portfolio, move your strikes around, and make sure you have a set exposure that's pretty close to 100% of your underlying asset. And, there's obviously value in harvesting the volatility in options. That's why this category has grown so fast. But if you're doing so and you're getting better risk-adjusted performance, but not total return, it can be quite frustrating for the end user in that. So that's one of the reasons why we have this regular rebalancing process up to 2 times a day to try to create a strategy that does harvest the volatility, that does give you better risk-adjusted returns, but also has the potential for top-line outperformance. And it's not magic; it's just pretty simple math. And so that was our first main concept, is being a risk manager over a strike seller. And secondly is distribute responsibly. And what do I mean by that? I think a lot of people got attracted to this space because of a number of ETFs that had 50, 60, 70, 80, 100% distribution rates. Just because you have a high distribution rate doesn't mean you're actually garnering or generating that much premium or yield in your portfolio. You have to actually be able to create the returns that you plan on distributing. And those come from, in our process, in these income stacked ETFs, three sources. One source is just simply the exposure of the underlying portfolios. So in our income stacked ETF, we offer a 200% basket to two different asset classes at the same time. ISSB gives you exposure to both the S&P 500 and Bitcoin at the same time. ISBG gives you exposure to both Bitcoin and gold at the same time. So what do I mean by distribute responsibly? You can either get returns from the returns of the underlying asset class, returns from diversifying between different portions in your portfolio, in our case, either stocks and Bitcoin or Bitcoin and gold, and then returns from harvesting the volatility, because volatility and options prices are generally priced a little bit too high. So by harvesting that volatility, you get to realize that volatility risk premium. And so those three buckets are the sources of return in all derivative income ETFs. It doesn't really matter which strategy you're looking at. It's the returns of the underlying, returns from correlation benefits, and returns from harvesting that volatility. And so we set rebalancing targets that we think are much more realistic, so that we can offer an ETF that we don't need to, as a manager, say, well, if you wanted a good experience, you have to reinvest half of your dividends on a regular basis. We think it's much more prudent to just set a distribution rate that we believe we can actually hit over time. Obviously, there's always going to be volatility in markets, but if you have a distribution rate that you think can match the returns of the underlying, the returns that you get from the correlation benefits of these assets, and the returns from harvesting volatility risk premium, that's something that can be sustainable over time. You guys, I think, have asked for ETFs in the space that are more growth and income oriented. Growth meaning can also participate with upside rallies. Don't just cap the full upside. I think the onset of this whole category were ETF managers that would sell calls right at the money for 100% of the portfolio. And a lot of you guys then experienced looking at these Yahoo Finance charts that just looked like an endless staircase down, because when you had these big up days, you just weren't really participating as much, because that's how they were harvesting so much volatility. And that's why our strategy, candidly, is a little bit more complex than the average strategy. We do rebalance up to 2 times a day, but that allows us to have significant participation on the upside as well. And so that's why we are deeming these our income stacked ETFs that have equal 100% participation in 2 asset classes at the same time. Obviously, there will be bouts of volatility in the downside, but these are assets that we think over the long run will generally trend upwards. And on big up days, for example, last Friday, both of these funds are up over 10%, and you can see how much upside we truly have embedded into these ETFs, where you really do get to also participate on the rally of the underlying asset classes built into these strategies. And so this is a nice middle ground where we'll hit that 18 to 25% distribution rate. Again, that's on a 200% basket, so that shows you how conservative our actual distribution rate is. And we're trying to do so that you have a very good experience as a shareholder, and you don't need to worry about necessarily being a trader and making the hard trades yourself. I think there's a lot of individual investors who are very good traders, and there's a lot of really good products out there that you can act as if as a trader, but you have to do some very difficult rotations, some very difficult rebalances. And we wanted to offer full solution products in a hedge fund like fashion in this ETF wrapper, so that you don't necessarily need to be the trader or portfolio manager of your own assets. You can allocate a portion of your capital to a manager and allow us to do those very difficult and emotional trades. Take Bitcoin and gold. Our first flagship product, BTGD, was not in the derivative income space. It pairs Bitcoin and gold in a similar fashion. I think in hindsight, it seems a lot easier to think that you can do those trades as they occur. But when Bitcoin's ripping and gold's falling, it's very hard to make that difficult trade of trimming your Bitcoin and adding to gold, vice versa. When gold's rallying, as we've seen as of late over the last 6 months, and Bitcoin's falling, it's very hard to make those emotional trades and rebalance out of the asset that simply is going up and rebuying the asset that's going down. But the closest thing we have to a free lunch in this market is diversification. So embedding that diversification, we strive to give you products that do add the returns of the two underlying assets, but don't necessarily add the risk of the two. And that's because these assets are somewhat uncorrelated. In some cases, have over a long period of time zero correlation. There'll be bouts of positive correlation over time. But we're doing those very unemotional trades that can feel very emotional for individual investors embedded in ETFs to give you an experience such that we strive to have vehicles that, 3 years out, 5 years out, 10 years out will not only have higher NAV prices than they currently have today, but higher distributions on a per share basis. These are weekly paying ETFs. We paid our first two distributions so far of 9 cents. Our next distribution will be Tuesday next week. And, again, there will be volatility on a day-to-day, month-by-month, quarter-by-quarter basis in these assets. But if you do believe that stocks, Bitcoin, and gold have a place in your portfolio, this is a way to experience that participation, potentially have better risk-adjusted returns, better total returns, and also get that weekly distribution that whether you're using it to supplement retirement or wages for younger investors is something that you can expect, we'll have some volatility quarter by quarter, month by month, but over longer periods of time, we do very much expect, 3 years out, 5 years out, 10 years out, that you're going to see higher NAV prices and higher distribution rates per shares, which I think is really what you guys are all looking for in this space. So Ambassador, I just gave the world's longest intro, but I'll kick it back to you. And thank you guys all for having me on the show today.
So excited to have you and to be able to dig into this. I know we didn't start off the way that we really wanted to, but it is a pleasure to have you here. I will post the introduction for the both of you because I love doing that part and we missed that today. But I did want to dig in. Did you discuss how you get the 200% exposure? Did you unpack that yet? And if you didn't, can you unpack that for somebody who may not understand what a stacked vehicle is and how that actually works?
Yeah, so I think many people are familiar with traditional leverage ETFs, and leverage ETFs honestly get a little bit of a bad name. Everyone talks about like erosion in leverage ETFs and path dependency. Traditional leverage ETFs are trading vehicles. You can buy a 2x S&P 500 ETF and experience pretty close to 2x returns, but the onus is on you, the allocator, to make very difficult trades. That might mean 3 to 4 days a week. While it's running up, you have to trim it, and while it's falling, you have to continue to buy more to hit that 2x target over time. So it puts the onus and responsibility on the allocator to make some very emotional trades. The concept of stacking in general is meant to give you a leverage ETF experience with less need to do day-to-day rebalancing. We can't remove all path dependency, but we remove a very, very big portion of path dependency that you see in traditional leverage ETFs. It's not magic. We just simply do the rebalancing for you within these ETFs. So how we're getting our 200% exposure in these ETFs, primarily, most of our beta is coming from in-the-money call options. You'll see us buying the money call options on SPY, on IBIT, and GLD that are 10 to 20% in the money. And that's where we're getting the most of our beta from. And the beauty of doing it in that fashion, where we're using what's called flex ETFs, is that when we roll those options over, it doesn't necessarily mean it's a taxable event to the shareholder of our ETFs, which is just not available to individual investors. It's only available in the ETF wrapper. It's actually not available to all ETFs around the world. We are very fortunate in the US to have access to this quote unquote heartbeat trade that allow us to roll over these positions without it necessarily being a taxable event. So we can get this 200% exposure. We are not on margin ourselves in our account. We're using these in-the-money call options that gives us that little bit of leverage, that gives us that 200% exposure in a very intelligent institutional way. The concept of stacking is not new. PIMCO has actually been doing it in mutual funds since the 90s. They actually just launched an ETF version of their first fund they started that stacks in the 90s. They stack an S&P 500 and bond portfolio on top of each other. The beauty of stacking, I like to call it almost addition without subtraction. You might think that gold has good return possibilities over the next couple of years, even though it's run up. but you might think it might underperform equities. So you'd be worried to potentially sell some of your equities to buy, for example, gold. And that's a very fair concern, especially with how much gold has run up. But the concept of stacking makes it such that, for example, with this Bitcoin and gold stack, you don't need to necessarily worry if gold is going to outperform the S&P, because you stack it on top of your Bitcoin here, and it just has to outpace the cost of financing. So it's not magic, it's just kind of math. But this is something we're seeing a lot of the investment management space trend towards, is these slightly leveraged, diversified ETFs that do a lot of the difficult rebalancing embedded in the ETF. And that's really at the core of what we're trying to offer entirely as a firm, is better experienced full solution portfolios, that the onus is not necessarily on you to have to rebalance, have to buy and sell at different times, have to reinvest a lot of your dividends. You should be free to do with your dividend what you want. Obviously, when there's dividends coming from premium and upwards markets, there'll be some tax liabilities from those. But outside of that, like, this money is free and clear to either use in your day-to-day life or rebalance to any other portion of your portfolio. We fully intend to have a full line of ETFs that, again, are weekly paying ETFs, but we will never send a message in a year or two saying, oh, if you wanted a good experience as a shareholder in these vehicles, then you should have reinvested your dividends into the ETF. Our response to those managers are, you should have distributed less. And that's why, besides for our main messaging of being risk managers first, our second messaging is distribute responsibly and distribute at a rate that you think the underlying assets can actually support over time.
Okay, so a lot to unpack there. I want to go back and kind of dig into some of those things that you brought up. But before I do that, I want to make sure that anybody that's in the audience, that you are informed that you are welcome to raise your hand, come up on stage and ask or get your questions answered directly. I want to make sure there's plenty of participation today. David is completely transparent and open to answering questions. So please do that. Raise your hand, pop on up, say hello. So let me go back. When I hear leverage, typically it feels like extra risk. But the way you're explaining it is your leverage is created by a multiplicity of what you're leveraging by doing it with options, which costs less money, which allows you to have a delta one position without being extra risked. And this might show from last week. You had a trade where you did a in the money call at 50 on IBIT, and I kind of called you and I asked you, hey, I don't quite understand that. Could you unpack that and explain why that works and what it's meant to do?
Yeah, so there's two ways that we'll have less risk than traditional leverage ETFs here. So I won't say that, adding Bitcoin on top of gold overall is going to have less volatility than just Bitcoin alone. We've actually shown less volatility on the downside. But the beauty is that if we choose assets that have correlation benefits to each other, that we really mute that added volatility of the two independent assets themselves. So you get the returns of both, but you don't just add the risk of one plus the risk of other, because we are taking advantage of the diversification between the two. So as you alluded to, we're getting this beta from our in the money call options, which gives us that full exposure without us having to be on margin, without you as the allocator having to worry about being on margin or having margin calls, doing so in a tax efficient way. And where we're trying to find our alpha or provide alpha is how we construct that. So I think last week is a very great example. Bitcoin, especially on Thursday, fell significantly, and volatility spiked significantly in the entire IBIT options chain. And what that means is, as that asset's falling, the price that's being priced into future the options chain of IBIT is saying, wow, this is moving. We're actually expecting volatility for the next 12 months to increase. So the cost of these options are going up significantly. One, that's a dampener to us because we tend to have in our beta longer dated call options. So that volatility, we actually long Vega, is actually a benefit to us. And then two, what do we actually do with that benefit? And what kind of calls are we making, and how do we add alpha here in this portfolio? It's by, instead of trying to directionally decide which way Bitcoin's going to go, because candidly nobody knows on a day-to-day basis how these things are going to trade. You really have to look on a longer time frame. But last week, there's so much volatility in Bitcoin, in IBIT, we actually took that opportunity to shorten the tenors or the dates at which our options were. We had an over 1 year option on our bit in the money call option before Thursday, and then volatility spiked. We benefited from that volatility. We took that opportunity to then shorten our call options, which allows us to harvest a lot of that volatility and give us, again, a little less exposure to volatility in the IBIT market chain. We also took the advantage of the volatility there to actually add a little bit of puts on IBIT as well. Instead of making a bet on the direction of Bitcoin, we were making a bet on the direction of the volatility of Bitcoin. And we were betting that the volatility would go down. And it already has. We've already seen that come to fruition. I know Bitcoin's moving again today. I think it's down about 2% overnight. But these movements are much more normal in the day-to-day expectations of what Bitcoin should be moving. Versus Thursday, we saw this massive 10% drawdown. And, again, unlike some of our competitors, what you see on the opposite side of that is a day like Friday where both Bitcoin and gold rallied, and we were able to participate in 100% of the upside of both of those. And, I know a lot of fund managers are creating strategies, single option strategies, where they're like, oh, zero DTE is the panacea, or put spreads is the panacea. And the message that we're trying to give out is, there is no one panacea, no one option strategy that's always going to work. These are tools to be used by a portfolio management team. Just like anyone can go into a kitchen and cook a meal, not everyone can be a chef. It's how it's all mixed together. Ambassador, to go back to your original question, another way we dampen the downside a little bit is getting most of our beta from just a long call actually has an embedded put into it. A long call, a long in the money call is equal to stocks, to that stock performance plus a put. So if we're 10, 20% in the money, it's almost like having an embedded put in that position, 10 to 20% of that money. It's not going to erode all downside, right? But it's going to dampen those very, very, very big drawdowns. And especially in a slightly leveraged vehicle, that's really, really important to avoid the maximum drawdown possible in those days, because that gives you more ammunition to rebalance and bounce back up on the recovery days as we saw on Friday. And even if you're just, saving maybe 20, 30 basis points on a day like that, that really compounds over time and makes a huge difference. We got some questions in the chat here asking how much.
I just wanted to ask, and that's because it's a long dated call in the money. So if it was a much shorter dated, it wouldn't have that protection to the downside in theory, like you're talking about. Because it's long dated, though, you have the time of recovery and then the vega and the theta there to kind of dampen that downside move. Am I understanding that correctly?
Yeah, exactly. So longer dated option strategies have a little bit of volatility protection in them because they are long vega, and the shorter you are, the less you have that protection. I think a lot of people saw zero DTE strategies do really well last year, and you might ask, why did zero DTE do better than traditional 1 month, 3 month, 1 year call strategies? And that's because everyone expected a lot of volatility in the future last year, but it didn't actually come to fruition. So the volatility we experienced on a day-to-day basis was actually quite low. And so when expected volatility is high and realized volatility is low, having a hedge of volatility, which longer dated options gives you, is not beneficial. And it's actually beneficial to not pay for that hedge. And it's beneficial to get your exposure from shorter dated options, from zero DTE options. But what we've done here in this mandate is that's where the value add is. We can rotate how we're constructing this portfolio, how we're getting the beta, what types of calls we're selling. On the calls we're selling, we can go as short as 1 day or as long as 6 to 9 months, right? And that gives us enough room to make these judgment calls on the skew of the options chain, on the volatility surface, to add value, having some expectation as to where the volatility might go or where volatility is overpriced, versus trying to just say directionally, we think this week's going to be a good week for Bitcoin, or this week's going to be a bad week for Bitcoin. Even with all of that, irregardless of how we construct it, we're still going to have that 100% exposure to both legs on the portfolio.
Okay, I just want to say that we've sent out a note to Zeb to join. I know that he's part of the Discord, but we haven't seen him yet. So as soon as he does, we'll pop him up on the stage for sure. I'm going to definitely get to Brother AB's question because I want to kind of get into that AI and algorithm, but I wanted to go back. So when I've talked to other people about your funds, and I give the line that says you get 100% exposure on both to $1, I kind of get this glazed over look because that math doesn't necessarily math in a retail world. So I'm going to say it how I see it, and you tell me where I'm right and where I'm wrong. Is that all right?
Please. Yeah,
Okay, so
please.
the way that you've structured these is you have generated through doing having options and synthetics in some things, but some way of overlay to be able to have a beta 1 or 100% exposure to two assets because you're paying less to accomplish that. You can still do it with a single dollar that I'm giving you. And then on top of that, you're just taking a small portion of that, writing overlays to generate income to try to meet the income criteria that you've set out. Am I explaining that in a way that makes sense, or do I have that wrong?
No, that's perfect. So these are to 100% total exposure ETFs, but I think the real benefit of what we're trying to create here is not 200% exposure risk, right? So if you owned 2x Bitcoin and 2x gold and you just bought it and you held it, or a 2x cover call Bitcoin ETF and a 2x cover call gold ETF and you just bought it and held it, you will have a lot more risk without that rebalancing being performed, which again, if you can trade unemotional and you're willing to trade, 3 or 4 times a week, especially close to close around 3:30 every single day, like you can recreate what we're trying to do, at least in the non-derivative income version of this. But that's really hard to do, and it takes a lot of your time and a lot of emotions to do the difficult trade of essentially buying what's going down and selling what's going up. It's kind of as simple as that. So by embedding that into this, we do have a 200% total exposure ETF. Half of it is Bitcoin, half of it's gold. ISSB is half S&P 500 and half of it is Bitcoin. But we're not necessarily adding the two risks of the underlying together. And that's one leg of what we're offering here. The other leg is the expertise from our team in Convexitas to do the options overlay in a way where we can harvest premium in a realistic manner, create distributions off of that, and take advantage of what we see as opportunities in the options chain. As we alluded to last week, we actually had a tweet about our moves on Thursday last week that we put out earlier this week. And, again, the volatility that was being shown in IBIT last week was such that it was either going to erode to zero or bounce back massively. And that's actually what we saw on Friday was a pretty strong bounce back in IBIT. And the volatility has dropped significantly. So now you can see in our IBIT exposure, we have much shorter dated options, for example, than we do in our SPY exposure. We're still using over 1 year options and leaps in SPY to get our beta, whereas we are much shorter dated in the IBIT options because that volatility got priced so high.
Okay, so keeping it simple, stupid for a retail trader like myself, setting the expectations, because I think that's where this whole asset class has kind of stumbled and tried to find its footing, is matching expectations to results. So if I am setting my expectations, what I'm hearing to you, if I take out the cost of the leverage or the fund, I could realistically expect if I took the gain of Bitcoin over a year, let's say it winds up being 30%, and gold over the year winds up being 20%, that this fund should capture virtually like 96% of that upside on top of returning some type of income on a weekly basis. Is that expectation out there, or is that kind of what I should at least think to expect?
Yeah, so you should, exactly as you said, you should be able to expect to return the returns of one asset plus another asset minus, call it like a 4 or 5% cost of financing. And in normal markets, the benefit of diversification between these two legs will harvest a lot of that volatility or that path dependency or that erosion that you see in traditional leverage ETFs. look, there are going to be periods where assets are correlated together. We saw that last week where both Bitcoin and gold were correlated. So last week we experienced a little bit more path dependency. But over time, we expect that to not really erode returns in this vehicle. So as you alluded to, over a long period of times, when over full market cycles, we fully expect to offer A plus B minus a cost of financing and this nice distribution rate on a weekly basis.
Wonderful. Now, with that, you have both the Bitcoin and gold and S&P and Bitcoin that you introduced. You had other funds that were approved. Did you want to just, for a moment before we get to Brother AB's questions, kind of let us know
Yeah, please.
which those other funds are out there and which ones you might be thinking of bringing to market, in the near future?
Yeah, so we did pairs here. Obviously, we started with stocks and Bitcoin with ISSB, Bitcoin and gold with ISBG. We also have stocks and gold, ISSG. We have treasuries and gold. We have treasuries and Bitcoin, and we have stocks and treasuries. So we wanted to kind of mix and match all of these broad exposures in your portfolio so that you can get a 2-for-1 offering. You can either choose to allocate to other strategies with your freed up capital. You can hold it in T-bills if you want to hold a little bit of cash for opportunities and drawdown. We also have a little bit more complex strategies in this filing called MNAV harvesters, which are, again, meant to be more full solution hedge fund like vehicles. I can briefly explain those, but that might take us on a little bit of a tangent. The MNAV harvester series, you can think of our Bitcoin MNAV harvester as, if Misty, Winter, and BTCI had a baby. What I mean by that is there's times when, harvesting volatility on the long side of a crypto treasury company such as MicroStrategy might add value. There's times when it's overpriced. There's times when it's underpriced. But what we're striving to do is create a suite of tools and ETFs here that do those difficult trades for you, that won't make you have to be the trader to choose when should you be long MicroStrategy or short MicroStrategy versus Bitcoin, and do those rotations all within an ETF. So it's called the MNAV Harvester Series because we think the simplest way to value a lot of these crypto treasury companies, such as Strategy, is looking at the value of their Bitcoin, looking at the market cap of the stock, looking at the amount of debt they've issued, and trying to derive, is this overpriced or underpriced, taking into account all of its assets and liabilities versus its actual pile of Bitcoin. When we filed for that ETF, the MNAV on MicroStrategy was around 2, meaning MicroStrategy was trading at almost twice its actual value of Bitcoin. And so at a very high MNAV, we would just simply sell calls on MicroStrategy and be long Bitcoin through calls as well, and take advantage of that. Now there's some crypto treasury companies that are trading at less than 1 MNAV, and we may choose to then go long those. So that's our second portion of this filing. Our first portion is just these 6 income stacked ETFs, starting with obviously ISSB and ISBG, stocks and Bitcoin, Bitcoin and gold. The one that we've heard the most interest from the crowd is the stocks and gold, which we have not yet launched yet. But it probably in the coming month or two, we will look to launch that as well, and that'll pair again 100% exposure to stocks and 100% exposure to gold in one ETF.
All right, I'm going to come back to that because I have a couple questions there that I want to make sure that we get to. But before we do that, Brother AB is up on the stage. I also want to encourage anybody else that would like to come up and ask a question to make sure that you get your questions answered the way you'd like to. Please do. This event is for you. Brother AB, the stage is yours, sir.
Thanks very much, Ambassador. Can you hear me?
Yes, we can hear you.
Outstanding. David, pleasure to meet you. So yeah, I've been throwing a couple of questions there in the chat. I'm interested in understanding how you discern the pairings. So it sounds like your approach is dynamic tools and mitigating risk and actually earning the expense ratio that's being applied, which is music to my ears. And I'm curious to know, what goes into the process and how much of this is manual versus algorithm driven.
Yeah, I would say it's a combination of both. I think the expertise of a true portfolio management team, we've partnered with true experts in this space with Convexitas. These guys have been hired in their former roles as hedge fund managers and derivative income strategies, as option overlay managers on pension funds ranging from $5 to $50 billion pension funds. They have strategies that are candidly not suitable for an ETF that might have to rebalance even 5 to 15 times a day. So what I would say is there's definitely a lot of technology and pipes being built into automating what trades should be generated to get the target you want. But the value add in choosing when to lower the tenors and get that same 100% exposure is definitely human, because it really takes real expertise in this space to do that well. But the ability to take your opinion, or at least see what the market has, see where the opportunity sets, that's very much technically and algorithmically driven, so that the portfolio managers have a full tool set in front of them. I think a lot of people are like, well, how many options people do you have on your team? There are 50 to 100 person option teams that are still trading and generating trades in Excel and saying, okay, if I add this plus this, what is the beta now? And that's where the automation is automatically giving the portfolio managers tools, so they can say, well, if I want to get back to Delta One, I want to use 3-month options instead of leaps. How do I do that? And making it so that they can very quickly, instead of just doing the calculations, have the calculations automatically generated so that they can make their very good, quick judgment calls and focus their brain power on how to create these exposures and not how to calculate it. But to your point, I think also one thing we're really trying to do differently here is, as I alluded to, we have up to 10 rebalancing periods a week. There's some very quality managers that have some very good Sharpe ratio strategies that still will, just sell calls once a month, once a quarter, et cetera. And your risk to, for example, the S&P 500, or your exposure to the S&P 500 is going to be very, very different on every single day. And that's not on the prowess on the manager. That's kind of a random walk on just how the market performs over that time period. I know we have a number of hands raised here. I see Brad from Income Architect here. He does some amazing work covering all of these strategies, obviously alongside Rod and Miss Roundhill and Ambassador. But I think he's pointed out that, even in some of these 1.5x strategies, one day you'll have a beta of 1.3, the next day you'll have a beta of 1, the next day you might have a beta of 0.8. And that's not on manager prowess. That's just a little bit of a random walk. So to truly offer hedge fund-like strategies here, we think you need to have these up to 2 rebalancing periods a day, because even if gold or Bitcoin move, call it 3 or 4% overnight, you might go to sleep at 4 o'clock with a beta of 1 on Bitcoin, and you might wake up and it's 10:30, and now your beta is 0.8, right? And if you don't rebalance it, the next day your beta might be 0.6. And so then it's just kind of a random walk. You as an allocator, as a shareholder in those products, as to what your returns are based on just how the market moves over that time period, versus you can expect us to actually get that 100% delta, 100% beta target on both of these legs simultaneously.
AB, did you have a follow-up question to that? I'm not sure that you got all of your question answered there.
That's a great starting point, and I like what I'm hearing. That it's nice to hear something more dynamic and not just a zombie trading strategy of a fund manager being able to stand in defense of a one tool approach to solving income generation. If all you're doing is a covered call strategy, the market does not always favor that strategy. So having a dynamic approach is definitely what I am interested in hearing, and I appreciate that approach. So thank you for the time.
Of course, and I'll add on to that. There are times when that kind of simple cover call strategy, sometimes it's better to be doing longer dated options. Sometimes it's better to be doing 0DT options. The tool set you guys have available to you now, it's kind of the responsibility is on you, the allocator, to decide, like, when is it better to be shorter dated, when is it better to have a longer dated option strategy. Candidly, those are really hard decisions to be made. And that's where we tried to incorporate that and embed that in this strategy. That's why our iBet options are much shorter tenor right now than you see our S&P 500 options, because we had that massive spike in volatility last week. And, I think a lot of the times it's hard for individual investors to discern good from bad, other than like who performed better over a 3 to 6 month period on a Yahoo Finance chart. And you might end up just chasing the strategy that worked best over the last 6 months that might not necessarily be the prime way to structure that strategy for the coming 6 months or the current environment.
Yeah, I love the
Absolutely.
concept that you have reached a hand out to the retail trader and said, "Hey, we are willing to help you. I mean, you can still make decisions about diversification, which funds you want to be in, but once you've joined or invested into this fund, we're going to accept the responsibility of not taking hands off and saying, well, that was the strategy, we employed it, we did it exactly how we said we were going to do it, and now you have to live with it. You have a package that are saying, hey, we are entrusted with your funds. We're going to make the best decisions we possibly can." Very much like what it would have been in the 90s or early 2000s if I gave money to a hedge fund and I said, hey, here you go, do your thing. You're the expert. I trust you. You have a track record. I think we appreciate that. I know that I do. With that said, a couple people have popped up on the stage. I invited them up because they always have salient points and questions. They also are influencers here in the space, and I'd love for them to either give a take or ask a question if they'd like to. So as you please, go ahead and unmute yourself and go for it. Brad, I see you're unmuted. You are up, sir.
Hey, David, how are you?
I'm good. How are you?
Good. So I think you've been following me long enough now, and you're the one that drove me to the Sharpe ratio and all the rest of them, Calmar and the rest of them. And what it really comes down to, and this is more of a comment, and then I'm going to ask David to actually explain some of this, is when we're looking at these, and we'll take, I hate to say this, I'm going to just bring up a couple funds. When you take Neos and Tap Alpha and Goldman Sachs, they all three have different aspects, and they all three write different options. And what David is doing is each one of those options could be the right option for a particular week, but maybe not the right option today, right? And it drives that Sharpe ratio or any of the other ratios, the Calmar ratio, to one side or the other. Because I started with the Sharpe ratio at 1.8. It's dropped to 1.5. It's back to 1.6. And so it's really helpful for people to understand how this is all being dynamic. And so my question to David is can you explain to everybody at least what the Sharpe ratio is? And I am going to do a video on this in the near future of how these things in metaphorical talk actually work.
Yeah, no, Brad, thank you for that. Look, you mentioned three really high quality, high caliber firms. We talked about Neos, Tap Alpha, talked about, I think you said JP Morgan or Goldman Sachs there. And I'm not in any way, shape, or form discrediting anything they're doing. All I'm saying, as you basically alluded to, is we are doing our best to try to harvest the best of what all of those are doing and make those difficult rotations. When is a traditional 3-month cover call of like Neos more beneficial? When is a shorter dated cover call strategy like Tap Alpha better suited for your portfolio? And Brad was mentioning here Sharpe ratio. I think a lot of times it's really hard for individual investors to discern good from bad, other than going to Yahoo Finance and seeing which line went up further. And I think what Brad has done such an amazing job sending information to the marketplace doing is that not all upside returns are created equal. And so what Sharpe ratio does is it looks at how much return do you have given to how much risk you're taking. For each additional unit of return you're getting, you should also consider how much risk it causes to your portfolio. So it's a very, very somewhat complex formula that in its simplest sense is trying to normalize returns for each unit of risk taken. If you consider your portfolio as X amount of risk units you have, you don't want to just look for maximum return in each vehicle. You want to look for maximum risk adjusted return. You can actually take a strategy that has a higher Sharpe ratio, higher Sharpe ratio and lower return, and you can more comfortably allocate larger allocations of your portfolio to it because it's not necessarily going to add as much risk. I think I was actually talking to an individual investor 2 days ago who was talking about, I think he owned a 1.2x product from a competitor that I won't name in Ethereum. And he kept saying, yeah, I still have a 5% allocation to this. I want to wait for the rebound and then I'll probably look to reallocate elsewhere. And my response to him was like, well, if you have 5% allocation in a vehicle that has a 1.2x exposure, you can simply just sell it, book the loss, and buy a similar asset. He wasn't even looking for income. He was just looking for Ethereum exposure. I was like, you can just buy the iShares Ethereum ETF and put it at 6% of your portfolio, right? And that will actually almost have similar risk as the 5% and the 1.2x. And I think if I were you guys, how I would assess these managers first and foremost is on its Sharpe ratio. So in its simplest sense, Sharpe ratio is how much return do you get for each unit of risk. And for those that want a little bit more of the mathematical side of it, it's what is the return of that strategy minus the risk-free rate, minus T-bills, divided by the standard deviation of that strategy. And this is a way that you can compare returns even across asset classes. Like, how do you compare the value of an equity investment versus a bond investment versus an income investment? They're taking very different levels of risks in your portfolio. So Sharpe ratio is a way to normalize those returns for each unit of risk. A bond fund that returns 7% a year and an equity fund that returns 12% a year, at first glance, you might say, of course I want the 12. But what if the bond fund had twice the Sharpe ratio of the equity portfolio? You could actually lever up that bond fund and actually outperform. And the best institutions in the world, they find an optimal mix of assets that they do obviously expect each asset will have a positive return stream, that taking into account the correlations between them, they find that optimal mix, and then they might add a little bit of leverage on that overall mix. As opposed to just going for the highest returning assets, you can both have better risk-adjusted returns and better total returns. And that's what, we're not the only ones doing Delta One targets. I believe correct me if I'm wrong, I believe Tap Alpha is also doing a Delta One target. A Delta One target allows you to have potentially better risk-adjusted returns and better top-line returns. Now, where we differ is we will change the way we will get that exposure. It won't always be from shorter dated options. Again, if you look at our Bitcoin and our gold exposure, the most of our beta is coming from in the money call options. Both of our options currently in those vehicles expire June this year. If you look at our S&P 500 exposure, or like in ISSB, our options there expire in January. At one point, weeks ago, we had longer dated options on all of those, but we had so much volatility in Bitcoin and gold that we said, you know what, actually it makes sense to harvest that volatility, lower the tenor of these in the money call options, and again, strive for both better risk-adjusted returns and better top-line returns at the same time.
That was a great
Brad.
question and input from Brad, Income Architect. Make sure you go over and give him a follow. Puts out great content on YouTube. Give him a sub also. Brad, I'll let you follow up, but I just expose my nerdy baseball statistic geek side of myself and say it's like playing Moneyball with your investments. I mean, getting into those stats and understanding it differently makes you look at a home run different than a walk, but in reality, it may be producing something that's better. So I love that. Thank you, Brad. I appreciate that. Did you have a follow-up there?
Yeah, just a follow-up for everybody. And what I've done personally, and this is just my personal experiences, if you prompt Gemini under think mode, it can give you all these answers. You just have to learn how to prompt. Or you can, the problem is these are newer funds. You can use Portfolio Visualizer and it will actually do all this math for you. So it's not like the tools aren't readily available for the retail investor today. 20 years ago, this stuff was not available. So kudos for David for bringing it up. And, I'm just running with what he's, literally taught me. And I appreciate him coming on.
It's great to have him
Thank you, Ben.
here. Amy is up on the stage also. Did you have a question, or did you just politely pop up on the stage because I invited you?
I was mostly being polite. David, thank you so much for advertising on YieldMite. I'm really happy that you all are my second sponsor. But I guess if I had a question, it would be under what circumstances would you expect your fund to do worse? Like in what I don't know if that was a good question. Sorry.
I think that's a great question, right? So when will the value of stacking be really additive to your portfolio, and when might it be hurtful to your portfolio, right? So what the basis of stacking is taking advantage of the diversification benefits of the two legs. So really, like when we shine is when the two portfolios move independently of each other, or at least somewhat independently of each other. Obviously, stocks and Bitcoin are going to be a little bit more correlated. There are periods, correlation is not a straight line. Two assets aren't always perfectly correlated every single day, where it's like every day they have no correlation or 0.2 correlation. So the periods when we will underperform are the periods when they are both correlated on the downside. Like candidly, last week was kind of as bad as it can get, where gold had I'm going to get a little geeky here. Gold had a 5 or 6 standard deviation downside movement. Bitcoin had a 2 standard deviation downside movement, and the two moved in lockstep together. Now we still have breaks built into these portfolios, where we do have somewhat of an embedded long put through how we're getting our exposure through these call options. And we still added value by harvesting a lot of that volatility in both of these assets, as I alluded to, by lowering the tenor of our in-the-money call options, lowering the tenor of our sold call options. So we did take advantage of that. But leverage ETFs will have some path dependency. We remove a whole lot of that path dependency, but the periods where we'll have a little bit underperformance is when both legs move in unison on the downside. There's still a lot of value we can create in those periods. But that's probably worst case scenario you can expect from a Bitcoin and gold pair strategy. It's candidly Thursday last week. And what we are so proud of is our response to that is still adding alpha, still lowering and lessening and dampening the downside, and also taking advantage, adding value, adding potential alpha to the portfolio by harvesting so much of that volatility that was prevalent in both those asset classes last Thursday. And Amy, we are very, very proud to be a sponsor on YieldMite. What she's built is really, really amazing. Actually, Amy, one thing I'd love to see on YieldMite is exactly what Brad and I were talking about, is some of the Sharpe ratio statistics, because I think that's a really good way to compare across different funds. There might be like 4 or 5 funds that do cover call strategies on Google alone. And how do you disseminate what's good versus bad versus looking at just overall returns and the distribution rate? I think a very good place to start beyond just returns is the Sharpe ratio. So I'm still hoping and waiting when we can see that added to YieldMite. But we're very proudly a sponsor on that. So thank you for partnering with us on that.
Yeah, I was just looking at my portfolio today. I was like, I would really appreciate if gold, the S&P 500, and Bitcoin would all stop going down at the same time.
Yeah.
Yeah, I've been thinking about that. I think I might add the Sharpe ratio in my build a portfolio section first. So we'll see how that'll work out.
Amy, we're
Yeah,
very
maybe
appreciative. Oh, I'm sorry. We're very appreciative for your website. It's a great tool that has helped all of us in this high yield space. And thanks for being so gracious to come up on the stage and just honor us with that question and talking. Lion, also, I don't know if you popped up just because I asked you, or do you have a question? This is my good friend Lion, one of the sharpest minds here in the retail investing area. Please, the stage is yours.
Oh, thank you very much. First of all, thank you so much, David. The last night we talked about the fund. It has been pleasure to have this discussion with you last night. So a lot of things we learned and we continue to learn. So I just wanted to extend my gratitude for the time spent yesterday.
A fantastic conversation. So.
Yeah, fantastic conversation. Now, I'd like to kind of a little bit touch upon some of those structures that you have in the two income space, the ISBG and ISSB. We talked yesterday about the that you use the long dated dip in the money calls that kind of you have like a range, and then you build two legs of shorting calls and shorting puts, right? And you explain why there is no spread, that it's pretty much going to be very expensive to do that, and it's not so beneficial with these strategies. My question is on the how you actively manage when there is a certain events in the market. For example, there are dates where there is FOMC meetings where there's a lot of volatility going, or things like where there is a job report on Fridays. How are you going kind of to manage the two legs of shorting calls positions and shorting puts position? Are you going to add additional legs for selling puts, for example, in order to get some more upside, or shorting the calls to kind of get more capping so that you can generate additional premium income by doing so? You can laddering basically the some of those legs. So I'm wondering your thoughts on that.
Yeah, I think you said it very well. Like there are times when an upcoming Fed announcement or an upcoming jobs report is being priced with a lot of volatility, meaning that the market really expects those announcements and those reports to very much affect the direction of a lot of these assets. So there may be periods where the volatility is exceptionally expensive around those dates. And if we do think it is overpriced, we'll do just as you outlined there. We'll be able to take advantage of it and sell calls around that date, sell puts around that date. Still, again, the whole time having this 1+1 structure, even with all these legs together, you'll still have that 1+1 exposure. But we will absolutely look to take advantage of bouts of volatility in the market to harvest that volatility. At the end of the day, that's what we think we're hired to do as derivative income managers here, is to find the bouts of volatility. If we think it's appropriately priced, we won't try to harvest it. If we think it's overpriced, we will try to harvest it. And so those are the decisions and the types of movements we'll be making these portfolios to try to add alpha over time beyond just this 1+1 exposure. So there are candidly some job reports that have a lot of volatility priced in around those days, and some that have much less. Every different report, every different Fed announcement has a different cost or volatility profile to it. So we then make an assessment, us, and when I say we, I mean us at Quantify Funds partnered with Convexitas as well, as to if we think that is overpriced or underpriced. I think people don't realize how many single events really are where the source of a lot of volatility is coming from. You know, if you look at NVIDIA, for example, like NVIDIA always announces their results towards the end of the quarter. They're the largest company in the world. Oftentimes, the NVIDIA earnings day announcements is where the majority of the volatility over a course of like a week or two is priced in. It's like, well, the market's basically going to go in the direction that NVIDIA goes, and we'll see how those results are. And so that might be an opportunity in its own to, for example, with something like SPY, to harvest a little bit more volatility around those events. And this is what a true professional options hedge fund team that with our partners at Convexitas is built to do and has done for decades, and making those difficult rotations. I think, there's a lot of really good ETFs out there, but I do think too many of them put the onus on you, the allocator, to assess when their strategy is good and when their strategy is bad. And candidly, Brad was talking about Sharpe ratios. Sharpe ratios are good. They're fantastic tools. But even a Sharpe ratio, if you looked at, NEOS versus Tap Alpha Sharpe ratio last year, you might conclude that Tap Alpha has a higher Sharpe ratio than NEOS. But that might just be because over a 6-month period, zero dated options, shorter dated options did better than long dated options. So like if you don't understand things like skew and the volatility curve of an options strategy, and when realized volatility is much less than expected volatility or vice versa, if those things sound like a foreign language to you, that's when I would suggest you find a manager who is at least trying to provide a full solution vehicle that says we will make those difficult rotations for you. There's certain managers out there who have regular videos where they just say traditional cover call ETFs are dead. Zero DTE is the panacea. Like there's nothing that frustrates me more than that. They're just catching the trend of what did really well over the last 6 months and trying to push products in that same fashion and just garner assets based on really fallacies of what did best over the last 6 months. Zero DTE is not a panacea. 3-month option strategies are not a panacea. Long-term 1-year leap option strategies are not a panacea. These are tools, and sometimes one will do better than the other. So I think there's a lot of really intelligent individual investors out there who can rebalance, and between them, I know I think Brad just did a video about using a couple of different strategies and just unemotionally rebalancing between them, and that captures that randomness. That means if you're doing that rebalance, you'll be trimming the one that did best and buying the one that did worst. But what we expect is there's a whole lot of people in this category who have realized they do want this income, but they don't want the responsibility of being the portfolio manager themselves. And that's why we're trying to package, as Brad alluded to, a little bit of what Neos is doing, a little bit of what Goldman Sachs is doing, a little bit of what Tap Alpha is doing, and basically rotating between different types of derivative income strategies in different market environments. Again, our option strategies look totally different on Bitcoin and gold today than they did just 10 days ago because of how this massive bout in volatility that we've seen in both of those asset classes. I alluded to it in a very geeky way last week. Bitcoin had a 2 standard deviation movement. Gold had a 6 or 7 standard deviation movement. That totally changes the entire pricing on all options, short dated and long dated in both those asset classes. So, as AB had said earlier, like, what is the point of allocating to a manager if they're not going to make rotations around these? Now, these aren't going to be rotations where we say, today we hedged the whole portfolio, we no longer have downside, and tomorrow we're going to remove that hedge. I think you've seen over time, it's a lot easier to be an investor than a market timer. There's been a lot of people who try to do market timing and eventually get blown up. Candidly, the only people who do market timing really well are high frequency trading firms and market makers, and even those firms blow up. I'd say on average, a market maker, high frequency trading firm blows up on average probably once every 3 to 4 years. It's kind of just like clockwork. So the best investors over time are looking for small edges and not necessarily totally changing their asset allocation model. So whether you take, Brad's approach of looking at Sharpe ratio and rebalancing between different strategies, or choosing a manager that's going to do those difficult rotations for you embedded in their strategy, like pick a manager who's earning their expense ratio, who's doing those difficult trades. We're now posting our intraday trade files every day on our website. You can see it, pretty much every single day we will have a trade on that trade file. I mean, every once in a while we won't, but my guess is probably 9 out of 10 days you'll see us post trades in that intraday trade file.
Awesome. This is a great answer, and thank you so much for elaborating on that strategy. This is pretty good that you have like a strategy where you can harvest this income when this opportunity presents itself, based on the market conditions, and once happens, you take an action. Just a quick follow-up I have. So there's because in this fund you have like gold, which also traded like on the COMEX, right, in the commodity space there. Are you looking at, as part of your strategy, to decide on how you are going to use the GLD for selling puts or calls at the beginning of the trading day, during the day, before we start trading at the future market, kind of to get the sentiment, how the things shaping up in the market? and then kind of decide based on that where you're going to put the strikes if you make that change. Is this something also part of the tools that you have available at your disposal? Yeah.
Yeah, I mean, stock markets aren't yet trading 24/7, but between futures and all these other derivative platforms, like you can start to see how the markets are trading, an hour and a half, 2 hours before the market actually opens, after the market closes. So we're definitely taking into account all the tools available to us to see how the tide is turning, what the volatility profile of all these vehicles look like. We are doing 2 rebalancing periods a day on this. They're generally going to be in the 10 to 10:30 range and the 3:30 range. Part of the mechanics of the ETF structure is you need a market maker to be able to confidently understand what the ETF will be, so he can provide a tight bid-ask spread. So, if you have to design a strategy that requires 15 rebalancing periods a day, generally, it's not yet appropriate for the ETF wrapper. I do think the ETF evolution is moving at such a quick pace that in a couple of years, you'll be able to handle a strategy that needs 5, 6, 7 rebalancing periods a day. But we feel very confident with 2 rebalancing periods a day. And occasionally, we may even do more than that on occasion, just not on a regular basis, that we can take all the information from pre-markets, post-markets, and make very good sound decisions and rebalance, somewhere between 7, 8 times a week, and offer strategies where we can harness the volatility, the movements in markets. We'll choose different times to rebalance based on different events. If it's a Fed day, we might wait for a post announcement, do it a little bit later, see the market react to the Fed announcement, and then do it. Or if we have a viewpoint on it and the volatility curve, we might be rebalancing during that moment too.
Yeah, that's great. That's great. Yeah. And the reason why I was asking about the future market, because it's all business hours, and kind of you need to get before the start of the trading day on the exchanges, you're going to get a sense and sentiment of from investors. Sometimes they can change over the trading day, trading session, but at least it gives you kind of an insight. Oh, that's great. I'm very happy with the answer you provided. One of the things that we talked yesterday is about the changes that is going to be developed as part of putting financial vehicles on a chain, which is probably going to be mostly around Ethereum rails. And we talked about this yesterday. And I just kind of want to make sure in this forum, in this community, also being discussed, so we all be informed about the future of different products, maybe in the pipeline. The question I asked yesterday is about creating a vehicle that would do similar stacking that you do today, but it's going to be with Ethereum ETH, and let's say the SPY or the market or something similar of that nature. Is this something that maybe you want to share with the community here, whether this is going to be something under consideration?
Yeah, I mean, look, we have a whiteboard of ideas that's probably 60 ETFs long. I think there's a lot of benefits to Ethereum. I think Ethereum is definitely going to be a higher beta product than an asset like Bitcoin. So I think if you were to stack Ethereum, it's definitely something we're considering. You have to realize that it's going to come with a whole lot more volatility. Sure. We do have one current product that does have Ethereum. It's less of a stacked buy and hold product. It's more of a trading vehicle. It's a 2x alt season basket, QXAS. That is currently 100% Ethereum, 50% XRP, for 50% Solana. That will not remove path dependency. That is a pure trading vehicle. That's why I don't tend to talk about it as much on the retail channels, because I want to mainly focus on the products that we built that we feel are applicable for buy and hold investors. We talked a little bit earlier. We do have this MNAV Harvester series. One is on Bitcoin. One is on Bitcoin and Ethereum. Those are slightly less leverage. Those you can think of more as like 150% long, 50% short, mainly because there's so much more volatility in an asset class like Ethereum that we want to be very careful if we are going to use it in a stack, and really keep the stacked nomenclature for portfolios that we truly feel confident you can buy and hold, and we will do enough rebalancing in between. So Ethereum also, unlike Bitcoin, is much more tied to GDP growth. It's much more tied to the development of AI, to smartphone sales, So it's going to move much more in lockstep with equities than even Bitcoin does. It's even higher correlation to the S&P 500 than Bitcoin. And assets like that are tied a little bit more to the GDP, to the economy, to growth cycles, to AI. Candidly, you might be better off just owning that without the income, because they'll have times when they go up a lot, times when they go down a lot. But I almost think it's almost better as a pure growth investment, less so as generating income in your portfolio on it. But I do think there's a real place for it in your portfolio. Again, we have QXAS, which is not a stacked buy and hold product. It's more of a trading product that currently has 100% Ethereum, 50% XRP, and 50% Solana. That is definitely not a buy and hold offering there. But Ethereum definitely has real use cases in our market. I think it's ironic right now. I feel like there's a lot of bears forming in the crypto space, and all Bitcoin needs to do well is just have time pass. We're just going to continue to print more dollars, and Bitcoin's lack of supply is going to shine. All Ethereum needs to do well is just to have time pass. It's continuously used in more and more applications. I think there's a lot of false starts in layer one technologies such as Ethereum, NFTs, this and that. Like, today's applications on Ethereum are very different than what we've seen in the past. Today, you see the New York Stock Exchange and NASDAQ talking about tokenizing stocks on Ethereum. You see BlackRock talking about it. You see JP Morgan making a stable coin on Ethereum. You see, third world economies and the participants in these economies using stablecoins as a vehicle to hedge mass inflation. If we think inflation was high here, you should see what it's like in some of these emerging market economies where your currency might go down 50% in 1 year. You earn money in some of these economies, and you're immediately trying to get out of your currency exposure because you have no idea if it might erode 5% a year, 10%, 50% in 1 year. We saw the Egyptian currency fall by 50% in 1 year. That's exceptionally damaging to wealth and your purchasing power that your assets have. And at the end of the day, that's all we are trying to do is, it's you don't want just your dollars and cents to go up. You want to preserve or grow your purchasing power. And so for us in the derivative income space, that's choosing stacks that, one, have correlation benefits, one, don't have so much volatility that will erode the benefits of stacking the two of them, and creating vehicles that can both have NAV appreciation over longer periods of time, over full market cycles, and distribution rates that can have appreciation that can surpass inflation rates over longer period of time. So I'd say if you want to judge us based on what our average distribution per share is in 3 to 5 years, and everything we're doing is built to have these, designed to have every chance to have both higher NAVs and higher distributions per shares. And I think that's what you really want. Again, on a week by week, month by month, quarter by quarter basis, there's definitely going to be fluctuations in both. Only actual bonds pay a fixed rate of distribution, and that's why they yield so much less. But in the derivative income space, we strive to create products that over full market cycles will have appreciating both NAVs and appreciating distribution per share.
Yeah, that's great. So this is a lot of things that we as an income investors looking at when we have an hybrid of growth and income. We want to make sure that when we invest in something, we give the fund manager our capital to work for us, that the capital will generate that cash flow, because many of us getting to the retirement age and we need to withdraw this distribution in order to live off the portfolio or to supplement, let's say, social security income or any other income coming from other sources. So one of the things that I was looking and doing some more research around the world moving onto the chain, is, as you mentioned, those projects that are related to tokenization and smart contracts, and being able to tokenize this asset and be able to trade it on 24/7 through on the chain. So with that being said, looking at this type of vehicles as a future for Quantify funds might, find an opportunity for you guys to find those new tools for us to invest. And other than just stacking, we would be able to. You can use like a ETF as an underline, which you can generate income like you do today with IBIT. You could do today with the ETH ETF wrapper that has a spot ETF or either from BlackRock or others that already providing an income. So there are some funds out there which I'm also working with other fund managers kind of to look at and see whether these opportunities present themselves for investors. So that's kind of my last comment. And thank you again for the time.
Thank you.
I greatly appreciate it. And I'll connect with you maybe offline. Thank you.
Please. Thank you,
Ryan,
sir.
thank you as always. Salient points and amazing questions. I appreciate you. David, it would be remiss if I didn't disclose that we are personal friends. I hope that I was forthright there and make sure that people understand that. Also,
Yeah.
I want to say that we've been on about an hour and 20 minutes, so we've taken up about as much time as we want to take from you. But I did want you to have a chance to just wrap up with anything that you might want to share, something coming up, something happening that we may have missed talking about that you wanted to share, and then we'll go ahead and close.
The feeling is mutual. You're a dear friend, and I really appreciate the opportunity to discuss what we're doing in detail. I've been in the ETF creation and portfolio management space for a very long time, and many of you have heard me say this, but one of the going rules is typically keep it simple, stupid. Right? There's a reason why single option structures, just zero DTE or just that. That's the reason why they do well. You can kind of explain them in 15 seconds, but I actually don't think that it's enough on its own to create long value over long periods of time, over 3, 5, 10-year market cycles, in just a single solution format. I think you need this level of complexity to really be able to add alpha and performance over multiple market cycles and be something that an investor can buy and hold for a long period of time. And so I thank you for creating the platform to allow us to talk about our strategies, which candidly I cannot do in 15 seconds. My marketing team keeps telling me like, but what's your 15-second elevator pitch? I'm like, guys, I need like at least 45 seconds on these, or if not more, obviously. So I'm very appreciative of these forums to discuss this, and I'm an open book. My line is open to all of you. My email is david@quantifyfunds.com. I will hop on a phone call and answer any questions with anyone who has any questions on our strategy. We do have a new filing coming live, or it's not launching, but the filing will be live on the 17th. And again, similar to this, I think we're really solving and solutions and problems that you guys have. And if anything, we strive to solve solutions for future market cycles that you may not even be aware of. So please look at our filing on the 17th. I think you'll find it to be very interesting. I won't be able to talk in great detail, but I can cover some of the things that will be discussed in the prospectus there. And maybe we can all link up and do something very high level on it, albeit maybe not an hour and a half, because I can't go into too much detail. But there's enough interesting things in that prospectus that I think you guys will find will pique your interest and be very unique. And as always, we're trying to, again, create hedge fund-like offerings, full product solution vehicles in an ETF, and be innovative and not just like copy what other people have done well. There's a lot of very good ETF managers out there, and candidly, there's a lot of ETF strategies out there that are almost like pulling in that same thread as that like a sports gambling nerve that a lot of us in America have, and we strive to do as much of the first and stay as far away from the latter as possible. Because at the end of the day, we take this very seriously. We own all our own ETFs. We want investment vehicles that can be held for 10 years at a time. And you will never hear a message from us in a year or two saying, well, these income strategies would do well, but you should have reinvested all your dividends. Like that is the last thing you'll hear from us. So we built these so you can, obviously there may be with the premium some tax consequence. We'll be as tax efficient as possible using those flex options. But we will never tell you that if you wanted a good experience as a shareholder, you should have just reinvested a portion or all of your distributions back into the ETF, because candidly, I think that my response to that manager is, well, maybe you just set your distribution rates too high. So that's it for me, and thank you all.
Of course, thank you so much. And for those who came up on the stage, I'm so very grateful to you, AB, Ms. Roundhill, Income Architect, Lion. My hat is off to you. We do have a go away question that I want to make sure I ask because it came up in the chat. Somebody wants to know your opinion on quantum computing and how that might, in the short term, impact what's going on, and then maybe a broader idea. If you could do that in less than an hour, that would be wonderful.
Yeah, what I would say is it's definitely a risk that's being priced into Bitcoin currently. I think that people who are creating these quantum computers don't have intention of using it for such things. But I would also say there are some who are saying that quantum computing may actually be able to be used to fortify blockchains even further. So all of these technologies, AI, quantum computing, they can all be used for good or bad. And that's why we have to hope we live in a government that has some framework that gives guidelines into how these are used. And I think the thesis on how quantum will affect Bitcoin is evolving every single day. Actually, Saylor on his quarterly call for strategy recently just said that he thinks that the advancements in quantum computing could also equally be used to fortify the blockchain of Bitcoin. So I think more to come on all of that, but I don't think it's going to be of risk to disrupting the entire blockchain. Even if it disrupts trading for a short period of time at one point in the future, the beauty of the blockchain is it's an open ledger. Like everyone has all of these trades. So I think it's unlikely to completely upend Bitcoin. But more to come on that in the future, and we might even produce some research and some content on that in the coming months.
Yeah, we'll definitely touch on that, as well as go a little bit deeper into AI and some options trading. Please let Zeb know we missed him and that we look forward to having him back. And then for anybody that's still stuck around, we plan to do this on basically almost a bi-weekly cadence. So we're going to talk about these things, make sure that we get the overviews, keep up to date on the funds that are coming out with Quantify, and generally just become wiser and more knowledgeable investors. So we thank you. Amy, it would be remiss if I didn't offer you an opportunity to kind of let people know anything you got going on, and also tell people about your website one more time, please, and thank you.
Thank you so much, Ambassador Kwan. I really appreciate you having these and the fund managers on and everything. I am the creator of YieldMax.com. It is a high income comparison tool where you have different modes, but basically you give it the amount of money you want to invest, and it tells you what your distribution would have been in the latest time period. So, and now I'm starting to get sponsors, so it's free for you to use, but you can subscribe to not see the ads and get some additional features. So, yeah, I'm just creating videos and vibing.
Please put the link or the website in the chat. That way it'll be there for people to see it. And with that, I'm going to say thank you, David. Appreciate it. AB, Amy, Income Architect, all those who participated. And since I didn't do it in the beginning, I need to go. This discussion is for educational purposes only and not financial advice. Nothing shared here is a recommendation to buy or sell any security. All investing involves risk, and you are responsible for your own decisions. Please do your own research and consult a licensed professional before acting on anything discussed here today. Pow, pow. We appreciate you all. And David, enjoy the rest of the time that you have there. Talk to you soon. And thanks, everybody, so very much.
Thank you, my friend. I appreciate this. I'll see you all here again in 2 weeks.
Bye-bye now.